Welcome back to AC Spencer Trades. I'm going to take you guys through a trading strategy today, which makes me between 5 and 10% profit every single month. It is so basic that my 5-year-old cousin could probably do it if I spent half an hour teaching him. So without any further hesitation, I'm going to take you guys into the charts, into the explanation of the trading strategy so that you guys can go away, back test it, and then of course take this into the real market and start generating yourselves some real profits. Now, this strategy does also work with trading on prop firms. It's got very low drawdowns and works in all market conditions. So it's going to leave you guys so much opportunity to enter into positions. You will not know what to do with yourself. So please stick with me to the end of the video, because by the end of this, you're going to be a master of trading London session and New York session with one strategy on one chart. So this is going to be traded on NQ, on the NASDAQ, and what you're looking for is the 15-minute overnight range. So you mark this out with the low and with the high of when the session ends, the New York session finishes, and then between 6 a.m. UK time. So from 9:15 UK time in the evening until 6 a.m. UK time, of course, in the morning. So you're marking out the low and the high, and you're drawing a full box around that low and that high. And when you use this box, you want to make sure that you've got the 50% target set on here. So when you draw the box, you can choose on TradingView to add this center line in here, and that's exactly what you need to do, because this is going to be used as your target. So please make sure that you put the 50% marker inside of this box. So once you've marked out the low and the high and you've got your box drawn, what you're looking for is simply a break outside of this box, outside of 6 a.m. UK time. Once you've seen this breakout, all you're looking for is a divergence within the RSI. So what a divergence is this is the RSI down here on setting number 9. This is very important. You must have it on number 9 setting. And an RSI divergence is simply where price is making higher highs, but the RSI is making lower highs. Can we see this? So where we made this high is from this peak here. And then where we made this further high in price action, we made a lower high here, which is actually on the RSI. So that is extremely important. The RSI must be overbought, so must be over the 70 line or below the 30 line. And that is where you can start looking for your RSI divergence. Now, this can happen in a number of different ways, right? This peak can still come outside of the box, but this one must still be higher, and we must still have the RSI divergence down here. So we must be creating new highs on price action and lower highs in the RSI. And of course, this can be flipped in the reverse of this. If we make a low here, 6 a.m. happens, and then we make a further low here, creating the divergence here, but the RSI would be creating higher lows. So it's very important. The RSI divergence is the key to this strategy, and then we just simply need a reason to get into this. So all of this right now is done on the 15-minute chart. Once we see that 15-minute divergence outside of the overnight box, then that's when we can drop into the 5-minute chart. Now, when we see this, all we're looking for is an inverse fair value gap. So a fair value gap is created between these two wicks here. We can see if this wick came down through here, that would not be a fair value gap. We have to have a gap between the two wicks of the first candle and the third candle to create that fair value gap. Now, once we've got this is obviously with the 15-minute divergence. We're looking for price to come down and close below this fair value gap, and that is our trigger to enter into the trade here. So as soon as you've got a 5-minute candle, you enter here, stop loss goes above the previous high, and then you target back down to this 50% of this box here. So there is not a fixed risk to reward on this as such, but if you're entering into this trade, say you enter into the trade here, and your stop loss is here, right, you're not going to get a very good risk to reward just trading it down to the 50% of this box, right? So if you're in that situation, then you always target a minimum of 1.5R, okay? So if you're entering into the trade here, stop loss is here, your target is going to be somewhere down here, which is actually outside of the full box. But it's very important that you make sure that you're getting that 1 to 5 risk to reward ratio. Otherwise, your long-term profits are going to be completely skewed, and you want to make sure that you're getting a decent return every time that you're entering into the trade. So 1.5R minimum returns, but always trade back down if you can to this 50% box, and that will give you 9 times out of 10 a between 2 and 3 risk to reward ratio, which is exactly what you're looking for to generate a really profitable strategy. Now, the reverse entry for this, if you're looking to go long and not looking to go short, of course, is just the flip of a bearish fair value gap, creating that inverse fair value gap. So you're always entering again on the close of the 5-minute candle, which breaks through the inverse fair value gap, stop loss below the lows, and targeting a minimum of 1 to 5, or preferably towards the 50% of that box. So that is the simple way of looking at this strategy, of how you look at it on the charts. Exactly the same. Stop loss here. We've got an inverse fair value gap coming through here. We enter into the position here and we target back down to the 50% of that box. Now, there's a few overrides of this which can happen. So if the RSI passes 85 or the 15, so if you're looking at a bullish RSI, this being the RSI here, and it passes past the 85, you no longer need a divergence. Divergence is not needed here, right? You can cross that out and you can simply enter on a inverse fair value gap. So if we're looking at this and we've got the RSI below here, this is overbought, this is oversold, and this is our 85 mark. If RSI comes up here, we're looking for a inverse fair value gap to happen in here, and we simply trade it back down. The divergence is no longer necessary, okay? So that is very important. And then, as I've said before, minimum target is 1.5R, and you want to trade it to the 50% of the box. But if you can't get to the 50% of that box, if you need to go further to get the minimum of the 1.5R, then you absolutely must do that. Whoa, oh dear. How do I go back? Okay, awesome. The other important thing to note here is sometimes, it's very rare, but you'll get a trade where you're trading back down to the 0.5 of the range, which has got massive risk to reward, okay? But it's very important that you don't go over a 5R, because this, from all the back testing that I've done, is detrimental to the profits. Often you'll see this come down to around 5R, and then it will reverse on you. And watching 5R disappear from your P&L is excruciating pain, and you should never be letting these types of profits get away from you. And then the last thing of the overrides is never trade against the data. If the macro data comes against you, if you've got a CPI print, if you've got an interest rate change, if you've got a manufacturing PMIs, whatever it is, never, ever, ever trade against the data. If you don't understand how to trade data, then please go and watch my macro data video, and that's going to explain to you exactly how you can trade this, and this will give you a very good insight of what you should and what you shouldn't do when you're trading with data on the table for that current day. So that's the breakdown of it. Now let's get into the charts and give you some real examples of what this actually looks like on the chart and how you should be trading it. A clean Nasdaq chart. Not really. Okay, so looking at the most recent example of this, we had one on Friday the 12th of June. Today we're on the Sunday. So looking at this, we have to draw our box from the high to the low, okay? So if we mark out the 9:15, which is the start of this blue box, and then if we mark out the 6 a.m., which is here, okay, so the box is actually drawn just like this. So what we're looking for, if we pull up the RSI, making sure this is on setting number 9, is a breakout of this box with a clear RSI divergence. So first thing we see is a breakout to the downside of this box, okay? But what we can see here is the RSI is actually not creating a divergence. So we created this low here, which created this low on the RSI. And then we created a further low here, and RSI also created a further low. So that is RSI and price action running in harmony. So we did not get a trading opportunity here. Now, what we do get is an RSI up here, which is overbought. And then we get a breakout of the box over here, which is below. So price action from here is making new highs, but RSI is failing to make new highs, okay? We're clearly coming down from there. So what you're looking for from here is to simply drop in to the 5-minute chart, okay? So once we've got that RSI divergence, which we've clearly got from here to here, we drop into the 5-minute chart and we look for a fair value gap. So we can see that we've got a fair value gap which comes in just through here, and we need the 50% line on this box here. So we add the middle line in here because that is going to be our potential target. So now all we're looking for is a simple break below that inverse fair value gap, which we're waiting for. Okay, that is our trigger to get into this position. So we enter in here, stop loss goes at the highs, and then we try to target the middle at the 50%, but we can't, okay? Because this is only offering us a 1.24 risk to reward ratio, and I said we need a minimum of a 1 to 5. So once we've got that 1 to 5, we're ready to go. We let the trade run, and we can see the stop loss position here is absolutely key, and then we crumble away and we come straight down to target, okay? Now, if you want, there is a variation that you can add to this. You can add a second target which goes back down to the bottom of the box. Now, if you're trading it in this variation, once you've hit that first target of the 1.5R, you want to be moving this stop loss down to break even and taking your risk off the table for that second target. That is very important that you do that, because quite often when it gets to around this 0.5, we can see it actually did it here. It came back down towards the 0.5, rejected up higher, and then failed to make a new high before continuing lower. So making sure that you do that, bringing your stop loss back down to break even, is incredibly important. Right, let's find a few more examples. Let's try and find a bullish example as well, so you can see what this looks like when you're trying to buy the market as well as selling it. Where's the 6 o'clock as well there? Okay, so we don't get a trade that day. This looks like a good one. We need the 15-minute chart, don't we? Yeah, perfect. Okay, so the next example here, we are looking at the 10th of June, so just 2 days prior to the last example we were looking at. We didn't get a trade opportunity here on the previous day, but we did get one here on the Wednesday. So exactly the same operation. We're marking from the high to the 6 a.m. low, which is coming in through here. Then we're looking for our RSI divergence, okay? So what we're seeing here is we've broken out of the box. We've put a low in here, which is this low on the RSI. Then we've created a new low on price action, and we can see that the RSI is failing to make new lows and is actually making higher lows, okay? So lower lows here, higher lows here. That is the divergence that you're looking for. Now, to trade this, all we're doing, again, is dropping into the 5-minute chart once we see that divergence. Now, all we're looking for here is a inverse fair value gap. So we can see that we've got a very small little fair value gap just coming in through here, and all we need is a break above that on the 5-minute chart, which is what we've got here. That is where we enter into our long positions, stop loss below the low, and then we target back up to the 0.5. Now, this is a much better trade because we can see that we're getting a 3.4 risk to reward ratio. We let that run, and we can see we've come straight through to target. US session opened here at 1:30 UK time, and that pushed us the rest of the way to the target. So that is what it looks like when you're trying to buy. So just a recap of exactly what we're doing here, okay? Just to make it absolutely crystal clear. It's super, super basic. We're entering our box at the start of the overnight session. We're closing the box at 6 a.m. UK time, which is just about here. So we've got the low and we've got the high, okay? We mark this box out. We need the RSI divergence. We can see we made this low here outside of our box with very low on the RSI. And then we can see the divergence. Price action's making new lows, but the RSI is making higher lows. We drop into the 5-minute chart. We look for a fair value gap on this next push down. We can see that we've got that fair value gap here. It gets inversed by this candle. Stop loss at the lows, target back to the 0.5 of the box. Very, very, very simple. Now, please go and test this. Go and try it in back testing. Go and try it in forward testing and let me know exactly what you think of it. I've done so much research on this strategy and it is incredibly basic. It's taking ICT, simplifying it and being able to use it in a very efficient strategy for London session and for New York session. So please, if you've liked the video, please give it a like, leave a comment of how you get on trading this strategy, and of course, subscribe if you've learned something new.